Investors are known to encounter different kind of risk, which include political risk, sector risk, company specific risk, different kind of risk. And so in this video, I want to consider how to safeguard your investments from political uncertainty or political risk. In a particular, in countries all over the world, there's that tendency that a government could or a country could experience political uncertainty. So in the event of political uncertainty, what would an investor do? How are investors expected to react? That's why I'm coming up with this video to tell us precisely, or to show us precisely how we could go about mitigating the risk that is involved you know with investing in countries facing political uncertainty. Number one is diversify across geographies. Number one, you are expected to diversify across geographies, across different countries. So in this case, you have global exposure. And when you consider global exposure, investing in a variety of international markets can reduce the impact of political risk in one specific country. And so geographical diversification will help spread risk across different political environments, reducing your portfolio exposure to political instability or uncertainty or risk in any given region. You equally have emerging markets. While emerging markets may offer higher returns, they are more often kind of prone to political instability. Balanced investment between developed and emerging markets can provide a kind of buffer when it comes to the prevalence of political risk. So you balance your portfolio between developed economy and emerging markets. Number two is focus on stable defensive stocks. You focus on stable defensive stocks. So you want to consider defensive stocks. These are stocks in sectors like utilities, like healthcare, like consumer staple. They tend to be less sensitive to political changes. And so this industry often remain stable during political turmoil, as their product and services are always in demand, regardless of the condition, of the economy and even the political climates. You equally want to advise you invest in dividend-paying stocks. Dividend-paying stocks actually are companies that pay reliable dividends, and these can offer a stable income stream to investors, and which makes them kind of less affected by short-term political fluctuations. So dividend stocks can be more resilient during periods of uncertainty. Number three is you monitor political development. As an investor, your ears and eyes must be open at all times. Make sure that you have regular news feed in your device, and so you stay informed. You can't afford to be ignorant. You stay informed, and so regularly monitor political events and government policies in the region where you are invested, because whatever happens politically would affect your investment one way or the other. And so stay up to date. Staying up to date will allow you to anticipate political risk and adjust your portfolio accordingly before the changes occur. You have to be proactive in your investment decision. You need to adjust your portfolio even before the action itself is taken, even before the policy or whatever is happening around takes effect. You make sure that your portfolio is adjusted accordingly. Number three is, number Number two, under subsection, under subheading three is act on signal. Apart from staying informed, you act on signals. If you notice political instability in a country which you hold significant investment, what do? You consider reducing your exposure or shifting to a less volatile country or region or industries, as the case may be. So make sure that you are sensitive to signals around you and make adjustments, whenever necessary. Number four is H with political risk instruments. You H with political risk instruments. And so in this case, you consider what is called political risk insurance. Political risk insurance. Some investors use political risk insurance or financial instruments such as options and futures to hedge against potential political events that could impact their portfolio negatively. So you hedge your portfolio. You could also consider currency hedging. When it comes to currency hedging, if you have a significant exposure to international stocks, you consider hedging, against currency risk. Political changes can lead to currency fluctuations, which may affect the value of your investments in foreign countries. So you need to, hedge against, political uncertainty and even currency risk, because when the country is undergoing political uncertainty, the country's currency may end up getting devalued. So please you subscribe to this channel and like this video if you've not done that. Number five is invest in companies with global operations. You invest in companies with global outreach. So in this case, you consider multinational corporations. So investing in companies with a global presence can reduce your portfolio's exposure to political risk in any single country. And so multinational companies tend to have diversified revenue streams because they tend to invest in different countries with different political environments. And so you should take this into consideration. It's very, very important as an investor. So you may also consider less political sensitivity. You may consider less political sensitivity. So in this case, multinational corporations often have more political flexibility and can adapt to changes, to changing political climates, by shifting operations or markets, reducing the impact of a localized risk. They have, operations in many countries. If a particular country, let's say for instance now, let's say maybe PZ or Nestle or any other multinational, it's not doing fine in Nigeria, they can shift the operation to maybe Ghana or any other West African country. So they have that particular advantage. They can shift operations from one country to the other so as to be able to lower their exposure to political risk. Number six is rebalance your portfolio regularly. You rebalance your portfolio regularly. So when it comes to rebalance your portfolio, you adjust for political changes. You adjust your portfolio to accommodate political changes. And so rebalancing your portfolio to reflect changes in the political landscape can help reduce risk. For example, even there are significant political risk in a particular sector or region, consider reallocating your investment to sectors or regions with lower exposure to political risk. You go to countries or regions or places where the political risk there is lower compared to where you're currently investing. You also look at risk assessments. In this case, you regularly assess your portfolio, your portfolio political risk, because that will help you to be able to know precisely, what action you need to take. And you should take notes of the shifting political dynamics or even upcoming elections. and how it will affect your portfolio. So you have to be very, very keen observer of the political environment. You may not be a political scientist or have interest in politics, but as an investor, these are things you can't afford to neglect, because one way or the other, their impact will then certainly touch your portfolio. Number 7 is invest in safe haven assets. Invest in safe haven assets. So in this case, you consider government bonds. Government bonds are known to be safe. You may buy investment grade government bonds, especially those from stable countries. They tend to perform well during periods of political uncertainty, and they offer, a safe place for you to park your capital. You also consider commodities like precious metals. Assets like gold and silver, they often act as a safe haven or a hedge during political turmoil, as they tend to retain their value regardless of whatever is happening in the economy and the environment. The value of these metals like gold and silver don't really change much. They're not really, they're not all that affected by the political climate. So, as an investor, it becomes necessary you have knowledge of the political environment, where you are operating, where you've invested your money, so that you will know precisely how to act in the case where you feel a certain political event would affect your portfolio negatively.